Summertime, often a quiet time for the market and stock traders, but so far this month at least, we've seen a few record high days in the Dow. The market also posted some intraday highs. Let's take a closer look at all this now with our chief equity strategist and economist, John Blank. John, against that backdrop, and even with all that excitement surrounding the SpaceX IPO, with the market's ups and downs lately, trading seems very orderly. Are we going to see this orderly trade play out for the summer, or is there volatility on the horizon?
Well, Terry, let's reference some data here. The last 5 days, the S&P's been down 1.6%. We're talking on the 25th of June. Last month, it's down 2.4%. So it's definitely down, as we know, from the tech rollover on the big chip stocks. Well, year to date, it's up just under 8%. So it's been actually an excellent half year. And over the last year, the S&P 500 is up 20%, which is definitely an excellent double-digit year. So, and we know that the earnings estimates are basically at 20% on an annual basis at this point in time. So, on a yearly basis, the S&P 500 with a big tech component is running along. But the issue here for us as investors, as the market is today now selling off some of these big mega cap names, is whether everything's been driven by CapEx and not underlying growth. And that's starting to roll over, Terry. So this might be as good as it gets for a while.
So, how do the underlying market fundamentals look now?
Terry, I personally think they're glossing up the reality. I think the economy is, basically a 2% or even less real growth economy. It's not falling apart by any means, but it's not robust in the manner that people are trading it. And that's would be my concern right now, is that really when you get a 20% annual return based on 20% annual earnings growth, the U.S. economy is only doing 2% real growth. I think you can understand my concerns.
Zach's estimates on the S&P 500 stocks offer solid 2026 EPS growth across all quarters. There's also some support for the market there too, right?
That is correct. It is a broad-based market for earnings estimates. I would tell you we're probably going to see that knocked down here if the oil prices continue to stay down at $70 and not 100, because energy and the materials groups that were tracking up with it, are probably going to sell off in estimate revisions. They're a little newer than that data you shared. And I think, like I said, we're going to get to a point where these pricey chips stocks are going to making profits on AI itself. The AI large language models have kind of disappeared from the discussion. But if they don't start making profits, Terry, from these expensive chip stocks, which are making it harder for them to do, we could see a big rollover here.
You've written that three strong S&P 500 sectors lift this stock market's fundamentals. Which are they?
Yeah, there are industrials and tech, of course, and to some degree the utilities. It's kind of a AI trade, Terry, with some lift from basically the industrials, which is kind of surprising.
Does that energy component surprise you, given the Iran story, considering that that sector is energy shock related?
Yeah, well, Terry, I took that one off the list of three because it would probably be in there from a 2 month or two ago and not now. So I would put utilities back where the energy sector was as a strong growth sector. And, we'll see going forward if we can sustain this. We've got a summer, and we're only not even halfway through it. So it will be interesting now that the seasonal job additions are coming out of the job market, and we start to see what the overall picture looks like after we get the Q2 earnings, which should come out here, not right away, but within a month or two.
Is your sense that those three sectors are going to be enough to sustain this bull market?
Personally, Terry, I think we're already seeing the rotation out of these big tech stocks as we speak, and so the answer is, I think we can sustain for at least a few months, just like in the '99 bubble period where people rotated out of the tech stocks into others. I think we can sustain the bull market for 4 or 5 months, but I worry as we approach the election about what happens after that.
The last FOMC meeting was the first one that the new Fed chair presided over. He indicated the likelihood of rate hikes going forward. Any indication of how the market perceives this new Fed chairman?
Yeah, I think they were surprised that it was a 12 to 0 hawkish bent to the FOMC decisions. I would tell everybody to hold their horses. We've got a lot of more meetings and a lot of different data coming in down the road, which is going to reduce the price inflation and which may change the tone of that various person. So I would hold off on the overall hawkish tone, much like the Fed has, and pencil in only a 25 basis point hike in December. I think people talking about 2 or 3 hikes in this year for this central bank are probably getting ahead of themselves.
So you think the market is already priced in that one rate hike for the year?
I think it has, Terry, but I think it's still trying to think that there's more there. I just think people forget the Fed has 8 meetings a year for a reason, and the reasons are the data changes, and so we've got some fairly significant changes in the data from the Iranian story, and we still don't know if the Strait of Hormuz stays open or shut. 2 months from now, when the 60-day ceasefire is over, so it's a lot of uncertainty, Terry, just like usual over the last year and a half.
All right, next are three Zacks number one strong buy large cap stocks benefiting from fresh covering analyst earnings upgrades: Micron, Caterpillar, and SanDisk.
Yeah, of course, Micron reported today, Terry. We've got a target price of almost $1,400 a share in our system, and it's trading around 1,200 today. If you think that's crazy, their next year earnings estimate is $121 a share, so it's only a 10 times earning on next year's latest estimates. And all the estimate revisions, quarterly, yearly, this year, next year, are just still going up, and only going up. No one's cutting down. So the picks and shovel story of Micron and Nvidia is live and well, but you have to ask yourself, Nvidia has already rolled over as a share price, and when is the climax top in for Micron? It might be as we speak, Terry.
Caterpillar.
Caterpillar is fascinating. This is one of these names that has gone up dramatically since the April lows of last year, 300 to almost $1,000 a share. And here, Terry, you have $1,000 share, much like Micron, but next year's earnings are only $30 a share. That's a quarter. So you've got a 40 PE on an industrial stock. We don't get into the bubble that may have formed in industrial stocks, but if I look at the Caterpillar chart, it's just screaming bubble to me, and I think that's fascinating because it's a bubble we're not generally hearing about in the news media.
And SanDisk.
SanDisk may be the most overpriced stock of all time, Terry. We have a target price of 2,300. This thing was trading at less than 200, down even the 150s last year. Insane, Terry, just totally insane. What are the EPS estimates for next year? It's $180 a share. So again, only a 10 PE on a stock like this. But again, you have to ask yourself how long SanDisk can make $180 a share on its chips. People can just simply decide not to buy something that expensive. And that might be the case if the large language models just simply don't pan out as strong profit makers.
Our chief equity strategist and economist, John Blank, on the summertime stock market. With John, I'm Terry Ruffalo.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.